Walmart and Target miss earnings, showing that the consumer is hurting from inflation, which sends stocks lower and the S&P into bear market territory. China shows some signs of stimulus as Beijing starts to open up, and the dollar retreats from recent highs. All this and more in this week's Macro Insight. All right, welcome back to Macro Insight, everyone. Today is the 24th of May, and let's take a look at these markets. So last week, what was going on? So we had a bit of a change, right? We had the dollar finally pulling back a bit, particularly against CNH and sterling. But in general, dollar pretty much selling off against all currencies. Tough week for asset markets with the S&P touching bear market territory. And US credit spreads continuing wider. Asian stocks, however, did manage to rally, and Europe was kind of flat to small down last week. UK and German two-year yields were higher on UK inflation prints, and a hawkish ECB. Obviously, they're kind of confirming what they're doing with regards to rate hikes in July. And the US yields were a bit lower along with inflation break-evens. Commodities, let me just bring up this graphic. So we bring up the usual graphic here. We can see, so we've got a lot of gray bars there over on the left. That's the FX. So that's basically other currencies rallying against the dollar. We've got those blue bars, which are UK and German yields. Commodities not really featuring too much in terms of the big movers, vol adjusted. You can see gold was 1 standard deviation up and copper was a little bit higher as well. But in general, commodities kind of having smaller moves than we're used to, and oil, tiny little yellow bar there. So oil pretty flat on the week. And then finally, cryptos were also quite calm. Then declines, but on a vol adjusted basis, pretty mellow. So not down too dramatically after obviously the recent madness that we've seen in that market. Okay, in terms of what was really kind of going on in terms of stories, the big one was consumer stocks. So you had Walmart and Target obviously coming out with misses. Getting absolutely punished. Walmart and Target down 20 to 30% even. So what was going on there? Basically, missing earnings, lower profit margins, showing that inflation was really kind of crippling demand from that lower tier consumer with kind of less disposable income. We're seeing inventory to sales ratios spiking to levels, that haven't been seen since just before the 2008 GFC. One silver lining might be that, these retailers, if their inventories are really going up by that much, they're going to potentially need to offer huge discounts in future months to offload a load of that inventory, right? And you might then see core goods prices come down a bit, which, we're starting to also see signs in the freight stocks that might be happening as well. So prices of goods, which obviously have been high when there was that strong demand for goods last year, are potentially now going to start coming down as these inventories have been building. Now, whether non-core prices such as food and energy, whether they stay high remains to be seen, right? Given the supply issues, they're probably not going to be coming down quite as fast. So watch this space. What crude does will obviously give us a tell on that. But in general, that's what we're seeing in the consumer stocks, and that's what we're kind of seeing might be then happening to prices and maybe a lead there on inflation. Yeah. In terms of broad market, seeing more and more evidence that we're in need of a technical bounce. And maybe we already got that, right? I mean, these bounces are getting shorter and more short-lived, and they're not really managing to rally that much. But courtesy of Mr. Blonde, right, who's a macro, for those of you who don't know him, macro analyst, putting a lot of good stuff out on Twitter. Got a Substack called Stuck in the Middle, I believe. So he's put out a few charts kind of doing his analysis as to why he thinks we're oversold and ripe for a bit of a bounce. There's a few people out there, a few commentators out there who kind of sympathize with that view and are covering short calls and things. They've had bearish calls, but they're covering shorts and stuff like that now because of that. So, what's he looking at? Simple things like, NASDAQ oversold on a weekly RSI basis, touching the 50% retracement of the whole rally from March 2020. That's one technical indicator there. If you look at news stories about recession and bear markets, seeing instances of those stories picking up, spiking to quite, high levels. If we look back at, prior sort of panicky type moves in the market, seeing a spike in those instances is often a bit of a counter indicator. If you look at some of these sentiment surveys, and, this guy does an average of a couple of sentiment surveys and then looks at the Z score of that. And then generally when you get a Z score of kind of -2, -3, that is usually a pretty good sign that we're going to get a 4 to 6 week rally, basically. Or the track record of that picking up a 4 to 6 week rally in the S&P is pretty decent, right? So that's this kind of table and chart here up on the top left. We've also had fund manager surveys from Bank of America, looking at institutional capital, saying cash levels are as high as they've been since April 2020, October 16. So that sort of thing, pretty much 20-year highs in cash levels there. And then we've got GS data on retail, showing capitulation in retail flows in terms of, their participation in how much of the market cap is retail flows. Also, looking at the usage of options. Obviously, retail were big call buyers throughout sort of 2021. That's kind of all evaporated. So lots of signs there. And then another anecdote would be, like I said, these macro analysts out there, like the likes of Julian Brigden, Mike Wilson, Michael Hartnett, people who I've mentioned before, are all calling for some sort of technical bounce, right? Michael Hartnett's got a bull bear indicator that is kind of showing a buy signal as well, right, for the first time in a while. So, even the people who are fundamentally bearish and who have been right are thinking this thing's oversold right now and need some sort of bounce. Okay, so I don't know if that's becoming a bit consensus, which basically means everyone's positioning for a bounce and covered all their shorts. And that just means we keep going lower, right? And we keep free falling potentially. But, we'll talk a bit about the vol signals and why the vol market maybe suggests that imminent crash isn't really happening yet. Okay. From my perspective, you guys know I've been fairly bearish, but even I've kind of taken some chips off the table there. Safest thing to do on shorts has been to book some profits, maybe leave some shorts on. Because I tend to do these things in options, I've rolled out of some June put spreads, as you know, for subscribers. Those went in the money, gave me some pretty decent leverage. I think they multiplied by about 4 or 5 in terms of premium. Rolled them, got rid of those, and then restructured, put on a new short in July, but did it via a short vol, short delta structure, which was a put spread collar. It was actually a ratio put spread collar. So that's how I'm now sort of resetting my money, still maintaining some bearish exposure, but with the idea that even if we get a bounce of 200-300 points in the S&P, that will only get to my short call strike, and I won't be losing any money on that trade until we go through that strike, in terms of if we look at it from a terminal option payoff perspective. Obviously, in mark to market, I'll lose some money if we rally up there quickly, but I'm comfortable being short those calls at 4,300 because that's a level where I'm happy to start getting short the market again more aggressively, basically. So that's how I've structured that. Okay, so that's kind of the short-term sort of oversold view. So we flagged last week that, waiting for a signal when to buy China. What did they do? Last week, they cut their LPR rate by 15 basis points to 445. So they've kind of committed to, $5.3 trillion worth of stimulus. And this is like an estimate or it's a target figure. Tax cuts are something that they've started to implement, which is obviously a good sign. Beijing has started reopening in a lot of districts. Not completely out of the woods yet on COVID because, their numbers aren't literally zero. But the fact that there is starting to be a bit more movement around Beijing is positive. So anyway, on the stimulus side, monetary and fiscal measures potentially amounting to 5.3 trillion. It doesn't sound like a small amount of money. It's not as big as a bazooka as we have seen in the past out of China, but it is still potentially going to be enough coming out of lockdown, and doing this at the same time may well provide a bit of support to that economy. Now, the question is it going to support the market? If we look at the price action of Chinese stocks, they haven't done amazingly overnight. I would kind of, 42 macro have started buying China. I was waiting to see when Darius was going to buy it. They've already started buying it. Me personally, I'm looking at FXI, which is the large cap China ETF, looking at call spreads on that, maybe out to something like November to give me plenty of time for that scenario to play out so that my, if my timing's not right straight away, I'll be looking at those call spreads. I haven't pulled any triggers yet. I'm kind of waiting for the price action in China to look better than the broader market, right? So what I want to see is similar to what we saw in Brazil earlier in the year, where markets were relatively weak, sideways to weak or whatever. Brazil just kept rallying, right? So I want to see that decorrelation of Chinese equities from other equities, particularly US. If I can see that, that's going to make me more confident that that move has started to play out. And you don't need to catch the bottom in that market, right? Once that move starts, that move has potentially got 30% of legs in it, right? So I would say, wait for that confirmation, wait for that decorrelation of Chinese equities versus everything else. And then we'll probably be able to get some November call spreads on at reasonable risk rewards, maybe 8-1, something like that. I'll be looking for that type of move in the 25% rally type by November, right? If we can get something like that, then I think that's not a bad setup, basically. So that's what I've got on my radar. And obviously you will know as and when I pull any triggers on that. Yeah. Okay. So that's China. If we then go to price action on S&P, we've got the spot gamma positioning chart up there. They saw the put wall shift lower to 3,700, which arguably opens up room for more downside. Typically, the put wall is where they see it acting as support. If that thing shifts lower, it's basically saying there's room for this market to go lower. Now, remember that positioning chart is kind of making the assumption that all of those downside options are street short, clients long, right? And that does typically tend to be the majority of the flow. But because we're seeing a few other signs that might not be the case, we'll talk about that, right? So obviously the VIX underperforming and us seeing 3,800 on the S&P and the VIX not managing to make any new highs suggests that dealers are not as short vol as it may appear in the spot gamma chart there, right? So that's one thing I'd be using as a counter signal there, saying that I'm not so sure. I mean, I don't think the street's overly long vol, that's for sure, because we are choppy, but are they that short vol and are they that short downside vol where you got the max peak of short positioning down at 3,700? If that was the case, would we be seeing VIX underperforming the way it is? Would we also, if you look at the bottom left chart, would we be seeing 25 delta skew get annihilated on the S&P and get to a place where it's less than skew on the Eurostox? So if you look at this chart, this basically shows you the Eurostox skew, 25 delta, which is normalized skew, which is the difference between 25 delta calls and puts in the 3 months, in 3 month expiry. And it compares it to S&P. And typically S&P skew trades more expensive than European skew, right? So Eurostox is obviously let's call it the S&P for the US, for the Europe. It's the most liquid index in terms of options. That skew is usually at a pretty hefty discount to S&P skew because you get a lot of protection buying in the S&P. And lately you've seen the S&P skew get annihilated. So now it trades below European skew. That to me is a signal that the street is not short that much downside anymore. If anything, they're long downside. And we've seen some sort of structural shift there in the positioning that we need to be aware of, basically, right? So I'm pretty confident that the street probably picked up vol down towards 3,700 as opposed to loses it, right? Based on that signal, okay? And then the hero chart there on the bottom right is just showing us what we saw in terms of flow yesterday on the SPYs. As the market was rallying, we saw nothing but put buyers. So that blue line rolling over from the morning all the way into the close is just put buying, put buying, put buying. So the fact that skew is so cheap and the fact that the market has rallied and the whole world thinks it's a false rally and a selling opportunity, that's people there taking advantage of that and coming in and buying puts, basically, right? So we didn't really see much on the call side, right? We saw a bit of call selling, bit of call buying, normalized, didn't do a lot by the end of the day, but we saw consistent put buying coming in basically as that market had its sort of a knee-jerk bounce, basically. So they're not hanging around and waiting for much of a rally before they come in and start buying puts again, basically, right? So if we do see more of that flow, maybe that flips the streak shorter downside, and maybe then we do start to see a bit of a bid come back to SKEW. So that's something to be aware of. And you can see the little bounce in European SKEW there. It's probably showing us, right, that there have been some put buyers come back in Europe, but we haven't seen enough put buying come back in US for that SKEW to really bounce yet, basically, right? So something we need to keep a close eye on, and don't worry, I will be doing that on your behalf, right? Okay. So that's kind of the equity summary. If we then have a look over at the dollar, that's been pretty active as well. So in the dollar, I'd mentioned to subscribers last week that the dollar here had a bearish divergence. It was kind of showing signs that it wanted to pull back. I didn't feel comfortable keeping all my FX options, so I took another third of them off. I mean, they don't expire till September, right? So they've got quite a lot of time on them, but I just felt like it was looking more and more likely that the dollar wanted to pull back, so take some money off the table. So that's what I did. So you can see here, we've got the bearish divergence in momentum. We kind of touched 105. We're all the way back to 102. This is in DXY. That sort of channel that it broke out of last month, the kind of support zone would be around closer to 101. So we've still got probably some support there around 101. If it breaks back into that channel, then who knows where it's going, right? But personally, I would favor that this was a sensible pullback from overbought conditions, needed to kind of happen, but we're likely to probably, find a bit of support at 101, I suspect, in the short term. Now, if we look at the emerging market currencies, you see Brazil flying 5% against the dollar, South Africa, Aussie, all doing well, all sort of in line with the commodities bouncing back as well, basically, right? But a broad-based move in terms of dollar against everything, really, pulling back against everything. Now, the euro is quite interesting. That's had a decent bounce. Now, that's obviously on the back of just general dollar kind of weakness, but also, euro had been really getting quite battered, right? So euro kind of needed a bit of a rebound. What were the kind of catalysts? Well, ECB has basically kind of reiterated that hikes are coming. So markets kind of expecting now 25 bips in July and September and an end to asset purchases. So this move in euro was kind of due. And the policy divergence has been very extreme, right? If you look at the chart on the right, you see that what the last sort of 12 years, what Europe's done in terms of rates, right? And how much it's diverged. The whole time we were hiking in the US from 2016 to 18, Europe did nothing, right? And so it just shows how slow they are to move, right? And now the fact that they are finally moving is probably a testament to how bad the inflation situation is, right? Given their track record. So the fact that, there was a high bar for them to move. Now that they are moving, let's see how aggressive they're going to be, right? But, if you look back at 2008, I believe, they have a track record of hiking into a slowdown. So it's not great. So let's see how far they can get rates up, basically, right? But I'm not overly optimistic on how far they can go. The relative economic surprise index, if you look at Europe versus US, has been turning up. So again, signs that, there is a need for them to hike rates and the European economy is not completely collapsing relative to the US for now. I'll be watching the 108, 109 area in terms of like resistance. Given the strong downtrend that this thing's been in, that would be the area where you'd be looking to maybe re-enter shorts if you believe in that downtrend. For now, not touching it. But like I say, if we get up there, I'll have a look at it and maybe enter some more bearish trades, basically, right, via optionality. Optionality will probably be quite cheap on the way up there as well, because in general, FX vols are all like coming back down as the dollar's kind of pulling back, right? So that's quite kind of a good thing for you if you want to re-enter option positions on that bounce, basically. Okay, so that's euro. Thanks for watching, guys. If you like this content, please subscribe to our channel, give the video a thumbs up, and hit the notification bell so you don't miss out on future videos. To watch the entire macro call, which includes the live Q&A and a walkthrough of all my top trades, you can sign up for a free trial to Macro Insight. If you join our exclusive trading community, you'll get access to our Telegram group, and you'll also get weekly market reports summarizing the macro call. The link is in the description to the video. And for more information, you can connect with us on socials, or you can visit our website, options-insight.com. Thanks a lot.